What's going on, guys? I'm going to do a video, a little bit different kind of context video on some stocks that, realistically, I do not trade. I'm not a long-term investor. I'm a full-time options day trader. I use technical analysis, not fundamental analysis, to enter and exit my trades. But I'm going to do kind of a technical analysis on two stocks that a very, 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 very big financial education YouTuber kind of always talks about and is always adding money on, right? If you know who it is, you know who it is. I just want to, and I know there's a lot of fanboys out there who love this stuff, but this particular YouTuber, claim to fame, obviously been in the market a long time. Not saying that they don't know anything about the market. They do their research. They're always kind of like up to date, but they're always kind of singing the same song and dance, right? I don't understand why stocks are going down. Companies got good earnings, and things are going to continue to go higher. Guys, be careful who you listen to, right? I mean, yeah, some people have made a lot of money, but also when you follow big time YouTubers, right? I mean, I'm talking big time YouTubers. When you guys follow big time YouTubers, they generate ad revenue, right? Obviously from the videos. So they're making a shit ton of money, and in the process they're continuing to buy stocks. And because they're making a crap ton of money, they're able to continue to buy the dip. They're able to get in on these, sort of lower cap stocks. They have one move, and obviously everyone looked like a freaking rock star in 2020. Ask Kathy Wood. Everyone looks like a rock star, but no one knows how to read a technical chart. Everyone wants to go back to companies got good growth, companies got good earnings, things for the future, so forth and so forth. Yeah, I understand that. But let's also go back to the .com bubble when a lot of stocks never came back. Now, am I saying that Oatly's not coming back? No, that's not what I'm saying. But what I'm saying is there's going to be a shit ton of stocks, maybe 20, 30% of these smaller cap, high growth stocks that don't come back, that they are being reset. Oatly never deserves to be trading at $29. Guys, you have to keep in mind, stocks don't just IPO or come to market as penny stocks. They get put there by the market. Sometimes they get corrected and they just stay. So here's what I want to kind of make a video on for Mr. Financial Education over there. So for Mr. Financial Education, you bought this run up, you buy a shit ton of shares, you make a lot of money. Woo, everything looks good, right? You tell all your followers to get in because this is a growth company. It's got good numbers. They're going to continue to grow. Maybe they do, maybe they don't. What I'm trying to say is I'm not trying to knock the company. I'm not trying to get into their balance sheet and all that. They could be a phenomenal company, but do they deserve to be trading at this kind of multiple up here at $29? So if you do know anything about technical analysis, you could have saved yourself a shit ton of money. Now, being that this is a newer stock, what I am looking at is the 1 day, 1 year chart. We're only going to go back to a year's worth of price action here, all the way to June. When we kind of came out, we exploded into 29. I'm sure a lot of people made a shit ton of money on this stock. But here's what I want to also take into consideration here. When we started to lose levels of demand, okay, so yeah, my chart looks nasty. It looks ridiculous. But I can also tell you that technical analysis, regardless of the fact if I was going to be holding a stock for 3 to 5 years, which you like to talk about, right, Mr. Financial Education, you like to talk about holding stocks for the next 3 to 5 years and so forth and so forth. And if they're losing trades after a year, you consider them a loser, or 2 years, you consider them a loser. When do you consider this trade a loser? When do you consider this investment a loser? You can continue to average down from whatever your average price is. Maybe it's 20, right? Maybe it's 15, maybe it's 10. The stock was trading at lows of $2.75. Now, to say that it's undervalued, yeah, fair play, maybe it is. But what if, okay, there's always the devil's advocate. What if the new kind of range for this stock is somewhere between 250 and around $7? And what if your average, and you're just a normal retail investor, and your average is sitting at around $12? You're going to have to constantly keep adding more shares down here to kind of accumulate to get that dollar cost average down a little bit. And then if we kind of just stay in that range for, let's say, 2 to 3 years, 4 years, do you realistically want all your money tied up? Now, here would have been the smartest thing to do, right? Here's the smartest thing to do. When we know the IWM, which is the Russell 2000, and the small caps started to come down, because obviously the smaller caps, the high growth stocks, the stocks with not such good earnings, the stocks with, potential in the next 5 years from now, those are all the stocks that got hit. All the retail favorites, Palantirs, the Skills, the DraftKings, the Oatlys of the world, the Beyond Meats of the world, the Pelotons of the world, although the COVID plays, they've all been completely destroyed and obliterated. So here's the thing, guys. When we do start losing macro levels of support, yes, you can say to average down, but what about the guy who bought on this run up here at 23? It goes to 29 thinking it's going to the moon, and then we start to pull back. We start to pull back. The small caps got hit first. And then we have, like our mega cap stocks, our Teslas are getting hit now. The Amazons, the Apples of the world are getting absolutely destroyed. And now you got retail getting destroyed, right? Look at what's going on with Target and Walmart. Nobody's safe in a bear market. To sit here and say that you don't understand why stocks are going down, we're in a freaking bear market. This is not rocket science. It doesn't take a brain surgeon to understand what's going on here. Earnings are going to get sold, good or bad. Every headline is going to sway the market, good or bad. Do you have to sit here and continue to, kind of hold your money in a losing, investment? You need to be an adult about this. Now, here's what you could have done when your stock started to lose. Like let's say for example the 50 EMA. Here's a rule of thumb for investors: if we're over the 50-day moving average, you're bullish. You're going to hold the stock as long as it's over the 50-day moving average. If the stock is over the 200-day moving average, you're going to hold that stock as long as it's over the 200-day moving average. This is not rocket science here. It doesn't take a genius to understand that. When we go below, it's time to short the stock and or ETF that it's attached to. So, why not when Otly did something like this and it came on up, down, up, down, up, down, up, down, all the way to $29. When we lost some of the shorter term sentiments, like maybe the 5 or the 10, yes, okay, I can see averaging down here. When we came down to the 200-day moving average, guys, that price was around $21. This is a time to exit this position. Now, if you firmly believe in this company and you're going to hold it for 3 to 5 years, I get it that why you're not going to sell out of it, because you don't want to miss the run up. But why not take the IWM short? Why not buy leap contracts on the IWM options, right? Options were designed to hedge your positions. Options were designed to hedge the market. So why not take, leaps, go a year out? You would have been profitable as all of these small cap and growth stocks came down. Go a little bit out of the money, make your money on the way down, continue to sell and continue to average out on your shares. But to go from 29 down to $2.75, guys, this might not come back, right? This might take 2 or 3 years just to get back to like $9. Now, I understand too. This is what I hear a lot by Mr. Financial Education. Every green day is kind of like, oh my God, did you see the green day? These stocks can move and they can move fast. Yeah, move fast. How? Like, these stocks go up to 20 cents and the stock is up 10%. So yeah, 10% is a big day on a stock like Tesla. 10% is a big day on a stock like Apple. 10% is a big day on a stock like Nvidia. But when you're talking about, your average dollar cost average on the stock is sitting, let's say, even on a stock like Otly, let's say you've been averaging down. Let's say your dollar cost average is $7.45. What good is 20% day going to do when it's only 60 cents and you're still trading at $4 and your dollar cost average is 7.45? So just kind of keep that in mind. If you would know technical analysis, which I know you hate technical analysis, Mr. Financial Education, but when you hate technical analysis and you don't want to get involved and you just want to wake up in the middle of the day and kind of turn on CNBC like those guys know what the hell they're talking about, makes no kind of sense. Because at the end of the day, yes, it did have a 3-day rally along with any other small cap. I want you to look at these last 3 days. 1, 2, 3. I want to look at a stock that's been beaten up like Skills, right? Remember this stock? Who remembers this stock? 1, 2, 3 days. I want to look at a stock like Fubu. You remember this pump and dump? Okay. 1, 2, 3. I want to look at a stock like DraftKings, right? DraftKings, I think, is a good company. DraftKings had a good day today. 1, 2, 3, 4 days into its supply zones here, right? You kind of get where I'm going at here with these stocks. They all look the same, right? Even if we look at the small cap ETF, which is the IWM, 1, 2, 3, 4 days worth of price action. This is called a dead cat bounce in a bear market. This is not rocket science. So, when you're looking at these stocks, you can't get excited thinking, oh, now we had the bottom. I need to buy more shares down here at $2. Because guess what happens? You run into the 20-day moving average here and the stock starts to come down. And now everyone's kind of wondering what the heck to do. Now, if this does catch support at the 5-day moving average, which currently it did close at. So I do want to make something very, very clear. For day traders and investors, whoever controls the 5-day moving average, which is the shortest term market sentiment, is going to usually normally control the next day. So if we lose the 5-day moving average tomorrow, we do have room back down to $3.31. If we do lose the 10-day moving average tomorrow of $3.31, we do have room down to $2.95. And anything below $2.95 can test the all-time lows of $2.75. Now, if this does decide to bounce, how much room are we looking at? we would be looking at a price of around 394, and then the 50-day moving average, which is your bullish or bearish sentiment, which is currently at $4.37. Now, if a stock like Oatly does reclaim $4.37, I, I will agree 100% that it does have room to run. You notice how congested all of these lines are and stacked on each other? There's a lot of choppiness action going on here. Do you notice how clear this is? This is where you want to be in a trade. This is where you want to be in a swing trade. This is perhaps where you want to start accumulating stocks for a long. You don't want to be adding shares at 540, and then you don't want to be adding shares at 520, and then you won't want to be adding shares at 350 all over the place when we're still under the 50-day moving average. I would rather just bundle in here and get in over 439, save myself the dollar loss here, eat the fact that, okay, I could have got it $1.50 cheaper down here at $2.75. Just eat that and just understand that if we get over the 50-day moving average of $4.39, we have room to 574. As long as we stay over the 50-day moving average, we hold this long for however long it takes. And obviously, if you're a longer term investor, 3 to 5 years, then definitely you're going to hold this stock for as long as it's over the 50-day moving average. And you want to take some profits accordingly. Even if you are a long-term investor and you do make a nice pop, stock goes up 10 or 15%, maybe 20% in a week on some of these small caps. 20% is nothing. It moves up 40, 50 cents. It can move 20% on the stock. You definitely want to take your profits. And if we ever lose the 50-day moving average again, you want to get out of the trade, because you can see the last time we lost a 50-day moving average, which goes all the way back here to February the 17th, we have never reclaimed it. And we went from a price of losing it at 726 down to a price of $2.75. So if we do reclaim this and you do get long, do you want to stick in the trade if we lose it again and maybe perhaps we go down to $1? Maybe perhaps we go back down to 275? No. So don't be so concerned on the day-to-day fluctuations if you're a quote unquote long-term investor. That's kind of just like feeding the fuel to a lot of the people that watch you. Now, if you want to do updates on a day-to-day basis, then you better be trading the stock, because coming into the stock every day when we're underneath supply and telling people to just kind of, you don't know why the stock is not moving up is it's blasphemous, to be quite honest, because the chart's telling you why we're down here. For one, we're in a bear market. For two, we have rising inflation. For three, the interest rate hikes. For four, Russia, Ukraine. For five, there's so much stuff going on. Every headline kind of sways everything, right? So just understand where we're at here and understand where we're at on the timeline. Personally, I think it's going to last until the end of summer, maybe even fall. But the question is when Oatly comes out, I know a lot of people are going to think bottoms in, which very well could be soon. We could be getting a rounding out process here on Oatly. I don't deny that. If we do get a rounding out process and we come up, the macro level that we need to get over is 579. Okay, over 579, that's where we're going to have room to stretch back to 10. That's the big trade. So over 579, you're going to want shares at $3. You're going to want shares at $2. You're going to want shares at $4. You're going to want shares at $5. You have an average cost under $5 and we run up $5, you're going to double your investment very, very quickly. But it's not time to get in until we can reclaim those levels of supply. First level of supply, 429. Over 429, 579. Over 579, this is where it has room to stretch. And we're talking about $10, $11, and $14. Now the stock, if you have an average price up here in the 20s or even in the high teens, this is going to be a little bit painful, because even if we do put in a monster run from here, it could still get rejected and come back down. And the range could be between $11 and let's say $5.79, right? Let's look at another stock, another famous stock, Honest, right? So we look at Honest, whatever, $23, same thing, down, 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 down. And this is a weekly time frame, guys. So if we look at when we lost the shortest term sentiment on the weekly time frame, we should have been exiting this trade at $15.33. If you didn't believe it and you wanted to continue to hold, when we lost the channel level here and we closed on a weekly price of $9.97, we should have got the hell out of the trade here. That's what is the message that should be sent. Not, oh, just buy here. Oh, buy more shares on the dip. Oh, buy more here. Oh, we're at $2.66. I don't know why it's trading down here. When these stocks come back, they're going to rip. Yeah, that's right. The stock can rip over $4.27 to 5.23 and over 5.23 to $8. But if your average is 14, coming up back to $8 does you no good. The only person it benefits is the super rich guy with YouTube revenue coming in every single month that has been buying all the way down here. You want to know who gets screwed? The average retail investor. Guys, learn technical analysis. It's not all about the fundamentals all the time. Fundamentals do play a point and a fact, but it's not always about the fundamentals. It's more about the macro picture. If you understand technical analysis, you would have learned to escape these trades or these investments and save some money on the way down. You could have got out at a macro point here between, let's call it, I'm just going to be very generous. We could have got out between $9 and $13, saved a heap ton of money, and now started to buy in down here for a run back up. A run back from $2 to 14 is a fantastic trade. A dollar cost average of 15, 16, 17, 18, or even 10 to come back up into that range is not such a good investment. I hope that makes sense. Just because when and if these things do come out does not mean that Honest in the next 2 to 3 years is going to ever touch $23. Now, could it touch $23? Stocks can do a lot of things. Fair value price is not always about the fundamentals. It's not always about what's going on. It is about market cycles. It is about sentiment, and it is about what someone is willing to pay for the stock at this point in time here, at this current week, going all the way back to 2021. Someone was willing to pay $23 for the stock, and that's what the stock was worth. Now, no one wants to touch this stock at $3 with a 10-foot pole. I wonder why, right? When you're underneath these levels of supply, no one wants to touch them until they can prove that they can actually work for you. If this stock like Honest is not going to prove that it's going to work for you, why is anyone going to put their money in there? I hope that makes sense. If you guys do want an intro on technical analysis or learning how to day trade or learning how to trade options, definitely join my channel. Not meant to bash, Mr. Financial Education, but I just find it cringy. I find it very, very cringy that, for someone who likes to invest in the stock market that much, doesn't know technical analysis enough to, kind of inform people where potential next support zone is or where potential next supply zone is, and just continues to buy without, kind of an end goal in sight. Like, you don't know where this can find a bottom. This found the bottom at 236. I could have told you that 236 is a linear regression channel 50 line. That's your demand zone, and it exactly bounced at 266. So it bounced 30 cents shy of the demand zone. Next demand zone on the stock, 73 cents. Like I said, stocks don't come to the market or IPO or SPAC into the market as penny stocks. They get put there. Am I saying that Honest is going to be a penny stock? No. But what I am saying is that this stock can realistically have a trading range between, let's say, $2.36 and $8 for the next 12 to 24 months. Do I think that that's going to happen? Obviously not. If the market wants to go crazy COVID ramp up mode, I can see it reclaiming 8, 11, and 14, and maybe that's a fair value for the stock. I hope this video makes sense. Make sure to subscribe to the channel. Drop me a comment. I know there's a lot of haters out there that are probably going to hate on this video because you don't believe anything about day trading. You don't believe anything that we do is serious, and you obviously just want to continue to follow the people with the big names on YouTube that are going to continue to give bad investment advice. Remember, guys, nobody on YouTube, myself included, is not a financial advisor. We are not giving out information and telling you guys what to buy. I know everyone kind of makes their own decisions, but it's just kind of heartbreaking to see that some people actually, trust what, someone is saying when they don't understand technical analysis. It'd be different if they were giving you technical analysis breakpoints and you can kind of use your fair judgment to kind of help manage your trades better or manage your investments better. Obviously, it comes down to you as an investor at the end of the day. But if I'm just going to paint a little picture before I end this video. If someone was to tell you, hey, at $9.97, your average might be $14. I understand you're down $4 or $5 a share. I understand that that's a lot of pain. But you know what? For the next year, you're going to not only lose more than $10 a share, but your money is actually going to be stagnant for over a year's time. Potentially, if we do start confirming 997, we do have room down to the next supply or next demand zone. And potentially this could be a 12-month hold where you're just in constant drawdown. Or you can take a $4 loss on your investment, kind of move on and you hedge your position and just go short the rest of the way until you find some support and go back up. So if you kind of knew that, hey, you know what, on this date here of 8/9 of 2021 could be the last time that Honest is trading over $10, this might be an opportunity to get out of the stock. Would you have gotten out of the stock? Now, mind you, it did bounce here for another 2 months. It went from a low price of $10 back up to $11.50. So in this time, people start getting excited and they start buying back in. But if someone told you, hey, we have supply, which is going to be resistance at around the price of $11.65, if it can't confirm that and then it re-loses $9, potentially could be heading lower. Would you have gotten out of the stock? It gave you two opportunities to get out at $9, once here and once here. Okay, so just kind of keep that in mind. October of 2021 was an opportunity to get out. August of 2021 was an opportunity to get out. If you would have known that there was no support, would you have stayed in the trade? That's the only question I have.